We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve Van Metre, financial planner, portfolio manager, and you all know him as the Bond King. How are you today, Steve?
I'm great, Tom. Thanks for having me back on your show.
It's great to have you, and I appreciate your suggestion of having you on to really help kind of explain and go through and actually address a lot of listeners' questions about the recent video that you made on your channel entitled, "Here's Proof That It's Not Money Printing." And of course, we're talking about quantitative easing and how it isn't actually money printing. So why don't we start by, giving the audience a quick overview that didn't watch that video. You addressed questions in that video such as, does the Fed print money? Do the reserve assets leak out into the economy? Does it cause stock, asset, and home prices to go up? So we'll get to all of those, but first we should start by explaining the route of how, money is created. So when cash enters the banking system, what happens to it?
Yeah, that's great, Tom. And if you don't mind, I'd like to kind of just go over the psychology of why is this so important right now? Because, we look, as we're recording, tomorrow is the FOMC meeting. We have this huge expectation the Fed is going to rapidly taper their balance sheet. And so where are we at from an investor standpoint? Why did I want to put this video out? It's simply because if you take a step back and look at how investors are positioned right now, what do you see? You see, if you look at retail investors, mutual fund managers, institutional money managers, hedge fund managers, you look across the board and then you look at the asset classes, what do you see? Overweight equities, overweight commodities, overweight precious metals, overweight crypto, and then underweight, of course, certain currencies like the dollar and bonds. And you start asking, why is this? And because there was this broad view that the Fed is printing money. And so if you hold this view that, okay, quantitative easing is indeed money printing, and that's what they're doing, well, it makes sense that those are the asset classes you want. Now, as we go into a taper and potentially end of the alleged money printing at the end of March, of course, then you have to start questioning these positions. But let's just say that what if you take the Fed is not printing money out of the equation? What do you have left? We have a house of cards, a highly speculative house of cards. And that's the issue, is the Fed was never printing money. But from an investor standpoint, what did they need to justify their risk taking? They needed to see it as money printing. And so they did. But that's why we're here to talk about what this really is and why it isn't what they think. So, as you mentioned, the question is, what happens when cash enters the money into the banking system? So where does this new cash come from? Well, it can come from one of two places. I can either borrow money from the commercial banking system and deposit in my account, or I can take it from an outside source. Could be physical cash I deposit, could be from a non-commercial bank that gets deposited, could come from overseas, could be anywhere outside the commercial banking system. When cash comes into it, the commercial banks have a liability. So you as a customer, we'll make you the customer, Tom, I'll be the bank. You have an asset, right? You have to say, I have $1,000 in my account that I deposited at the commercial bank. And I, as a commercial bank, now have a liability because you could walk in the door anytime that I'm open, or if we're online, any time of the day, and you can say, I want to transfer that funds out, and I have to give it to you. Mm-hmm. But there's some advantages that I have, and there's some issues that I have to deal with. One, you expect to make some interest on it. Now, fortunately, your expectations right now are extremely low, which is a really plus for me. But I also know that your money is not going to leave right away. On average, if it's a customer or retail deposit or a commercial deposit, it's going to be on the book somewhere 3-5 years in length. And so I know that. So I've got challenges. I've got this liability. I need to do something with it. I need to pay you interest. And I need to actually try to maybe make a little bit of profit off it because, well, that's what I am. I'm a bank. I either lend money or I make money on your money. So first step is new money enters the banking system from outside of it, either through a loan or through money that is not in the commercial banking system right now.
And just to kind of help clarify what we mean by commercial banking system. You said there's basically two main banks at this point. There are three, but two main banks. Bank of America. What's the other one, Steve?
Well, there are more commercial banks, but the ones that handle a lot of retail money are going to be Bank of America, JP Morgan Chase, and Wells Fargo. Due to the fact that Wells Fargo is under penalty with Federal Reserve at this time, the two main banks that are absorbing most of the QE purchases, most of the stimulus will go to Bank of America and JP Morgan.
Okay, perfect. So when it is deposited on their balance sheet, they see it as a liability, right?
Absolutely, because they owe that money. Right? You could deposit it and literally walk back in, walk out, walk back in, and say, you know what, I want that back, and they need to have it. As a customer, you expect them to have your money.
So then what's the next step, considering that, on average, they see that you are going to leave it in there somewhere between 3 to 5 years?
Yeah. So the next problem the bank has is, well, now they have a liability. And if you're a business, well, you want to have as few liabilities as you can, as more assets that you can get. So the bank needs to transfer that liability off its balance sheet to somewhere else. It can do it through the function of lending, but we know that there's not a lot of lending demand right now. So, and it's certainly not enough to deal with all the deposits. So what the commercial banks do is they take customer deposits and they purchase U.S. Treasury securities, predominantly short-term Treasury bills, but also Treasury notes, and they try to build out their portfolio to have what's referred to as an average duration of somewhere between 3 and 5 years, with a closer range of 5. And when we talk about duration, what does that mean in terms of a portfolio perspective? As a portfolio manager, if I'm thinking of duration, then what I'm thinking of is my portfolio is maturing around that 5-year mark to be liquid to deal with money flowing out. And that's what the banks are looking at, is making sure that as that clock ticks down, that money on deposit becomes available. Well, what's the best way to do that? Well, the way to do that is you go out, you buy Treasury bills, Treasury notes, and build out your portfolio such that the maturity of those bills and notes averages out to the time horizon you want. And what's neat about this, Tom, is when we look at this from a balance sheet perspective, all the banks are doing is taking that liability off their side and they're transferring it to the federal government. And that Treasury security is considered an asset on the bank's balance sheet. So if we now zoom back out, what do we see? You as a customer, you have an asset. I as a bank have an asset. And the U.S. government has a liability. As far as we're all concerned, we're happy because the government, it needs someone to buy the debt. You need to make sure your assets are earning interest. And now I have Treasury securities, which pay some interest. And I give you a very small amount of that because, again, as we've previously discussed, you have very low expectations for what I'm going to pay you. And I make a little bit of money on the difference.
Mm-hmm. So then, Steve, explain to us how QE actually comes in there. Is that the Fed coming in and providing that liquidity for the bank to consider an asset on its balance sheet?
That is a great question. So the process we just described, and I want to introduce a term, is called a bank reserve. So that process of taking a customer deposit and buying a Treasury security is creating a bank reserve. So all the Federal Reserve is doing is what's called, what we'll look at as a reserve swap. And so they're coming to the bank and saying, okay, you've got this Treasury security. We're going to take that from you. And we have to give you something in exchange, because we're going to take an asset off your balance sheet, but to keep the transaction balance sheet neutral, we have to give you something else, an equivalent asset. So all the Fed is doing is just swapping assets. Now, what's interesting about that is, in a sense, they're forcing the fact that they need money to come into the commercial banking system. They need money on deposit. So how do you get people to put money on deposit? How do I convince you as a customer of my bank to put money on deposit and perhaps not put it in, say, a CD or a bond or something else? Is, well, if rates are low enough across the board and you come into the bank and I say, hey, Tom, I've got a 3-year CD at a marginally higher rate than you could have in your fully liquid savings account, you go, well, I don't know that I need the money, but it's not worth tying it up for 3 years for that, minuscule amount of excess interest. Mm-hmm. So rather than tie it up, I'll just leave it here. I still don't know what I do with it, but at least I have the opportunity, if I want to pull it out. And so what happens with QE is that suppression of interest rates leads to an increase in the money supply, not because the Fed is printing money, but because consumers look at their savings choices and go like, well, I'll just put it in cash or checking or just some form of, liquid deposit. And that's what causes the money supply to rise.
So you touched on a very important point there, and that's the QE really suppresses interest rates, right? So let's just kind of walk through that again, how that really incentivizes people to be putting their money in the banks versus buying CDs or let's say treasuries, so that yes, it drives down the interest rates, but it provides, a tiny bit more incentive to deposit that cash.
Right. So let's just say, for an example, a deposit rate is 0.1%. And you come into the bank and you say, I'm really unhappy with this rate. I'd like to earn a higher rate on my savings account. And so you sit down at my desk, I'll be one of the managers or something. I said, well, hey, Tom, great news. How about a 3-year CD at 0.15%? And you're like, why would I do that? Why would I tie my money up for 3 years? And if I wanted my money back, pay a penalty for 0.05% more per year. It's not worth it. And that's what you see as a customer. And so that just incentivizes creating more and more money on deposit because there's really no alternative for short-term savings.
Mm-hmm. So Steve, why don't you pull up the chart that you have of how the dollars enter the system, what they get swapped for? And the other question that I have for you is, aren't there reserve requirements and limits for these banks as they're operating?
Yeah, the reserve requirements were removed.
Oh, interesting.
So yeah, they don't care, which is interesting, right? All right, so let's see. Okay, so we've already discussed what a bank reserve, and that is when new cash enters the banking system. And so we see here, customer has a deposit, commercial bank has a liability, and to create that bank reserve, that liability needs to get shifted. In this case, it gets shifted to the U.S. government. And now the commercial bank has an asset. This right here where it says U.S. Treasury, this is called a bank reserve. And the very important part to understand here is that this is purchased not with bank money, not with the commercial bank's profits or their house money. It's purchased with customer deposits. Mm-hmm. So, that is the key. So when we look at, did money get printed? Well, I didn't receive any money, printed money from the government. So the answer is no, it's not money printing from this standpoint so far, because again, it's all based on a customer deposit. So if we look at what Fed Chair Powell said in his press conference when he was asked, he said, we're simply changing the nature of a bank reserve or the duration. And that is what's really key, is that 3 to 5 years of the portfolio gets shifted. And so as we discussed, that what we have here is a actual reserve swap. The Fed's process has to be balance sheet neutral. So they can neither create money nor destroy money in the process. It has to be a neutral exchange. So what happens now is the liability of the U.S. Treasury doesn't change. So government debt is still the debt of our government. But what the Fed is doing, and you almost have to visualize this, they're taking that bank reserve and they're putting it on their balance sheet. So they're moving that Treasury security from the bank's balance sheet to theirs. So it's all they're doing is shifting it over. Now they have to give back the bank something in exchange. Mm-hmm. And so what we call that is a reserve asset. And what it is effectively think of it as an overnight duration Treasury security. It just matures every night. That's all it does. Instead of maturing like a T-bill, perhaps every 4 weeks, 8 weeks, 12 months, or a note maturing, at 2, 3, 5, or 7 years, it matures every night. Mm-hmm. And the Fed pays a whopping 0.015% in interest on it. And when people often ask, where do they get the interest from that? Well, they have all this Treasury securities that are generating on their overall pool of money more interest than they're paying on the reserve assets. So there's no money printed there either. Mm-hmm. They're just taking that interest that they're earning on their pool, netting it down to a lower number and paying that on the reserve asset. So from the commercial bank standpoint, they still have an asset on their balance sheet. The government still has the same liability. The only difference is who holds that Treasury security is no longer the commercial bank. It's the Federal Reserve. From a customer standpoint, their deposit is no longer backed by the US government. It's backed by the Federal Reserve. So again, as we look at this, not one penny in money was printed. All they did was just swap where that asset was sitting.
So Steve, this, I think it's really important to reiterate that we're talking about specifically about quantitative easing, or QE here. And we'll get into some other programs after that. But when you're talking about the duration of the U.S. Treasury asset, and you said it's an overnight security, is this a good spot to address what the repo program is, or the reverse repo program?
No, the reverse repo doesn't really show up in this event.
Okay, perfect.
That would be more on the money market side. So what you saw is too much money building up in money market accounts as commercial banks were trying to shed, this cash. They wanted to get this cash off their balance sheet because the banks get penalized by holding more cash, which is funny because the government did a bunch of fiscal stimulus to give the banks more cash. And then they turn around and penalize them because, hey, you've got too much cash. So, the people wanted more interest. They went to money markets. The problem with the money market accounts is, well, those too are backed by treasury bills. In fact, the laws changed. I forget when. I did a show on it, so I don't remember the year. But the law it didn't specifically state that you can only buy treasury securities. But it's one of those things where if you look at all the list of requirements, there's only one thing that meets it. It's treasury bills. And there's a shortage of them. There's just not enough treasury bills in the market. So what happens is they don't have the interest to pay all these deposits or all the cash in the money markets. So what the Fed is doing is loaning the money markets securities overnight, which they're required to have by law, and they pay interest on that in exchange for the money. And that's all it is. So all we see in the reverse repo is just a shortage of treasury bills.
Okay, perfect. So one of the other parts of the video that I think we need to address yet is how QE actually traps dollars in the commercial banking system and how it actually drives the value of those dollars up.
Yeah, so let's go back to this slide here, because I think this is a real good illustrative point. What is the Federal Reserve trying to do here? Well, if we go, let's go back up a couple of them. So when the bank holds a U.S. Treasury security or a bank reserve, it's theirs. It's tied to customer deposit, but let's say a bunch of customers come in or say, hey, we're going to come in and request our cash. Well, the bank has the ability to sell, even prematurely to their plan, to sell these securities, these bank reserves, get cash, and give it to the customers. So the banks have total control over this. Because again, they've acquired it with customer cash, so they can add more, they can sell them, they can do whatever they want. Now, when you get to quantitative easing, what's interesting is now that Treasury security is shifted on the Fed's balance sheet, it effectively gets removed from the financial system, because I can't call up the Fed, or if I put a trade in for a Treasury security, I can't say, can you route that to the Federal Reserve because I'd like to buy one from them, or I'd like to sell to them. You can't do that. So they get removed from the financial system. So they're sitting there out there on an island by themselves. Now, these reserve assets, again, it notes it's an asset of the commercial bank, but it's really key to understand, Tom, is this is property of the Federal Reserve. It belongs to the Federal Reserve, and these reserve assets are held at Federal Reserve member banks on behalf of the bank that they're tied to, of what that bank's asset is. So the Federal Reserve prevents the commercial banks from selling these treasury securities because it can't. And the banks can't go sell these reserve assets because they're not theirs. So what happens is it forces this money to get locked up in the commercial banking system where it can't leave. And that's where you start to see a chart of the velocity of money just start spiraling lower and lower and lower. And this is where where the number of commercial banks start to matter. And the reason we focused on 3, which is not the actual number of commercial banks in the U.S., but it is the primary 3 that handle retail deposits. And then when you start looking at that, you see that most of the money can bounce between JP Morgan Chase and Bank of America, because Wells Fargo's capped at its size. They don't really want more money and they can't really handle it. So there's not a lot of movement to Wells Fargo. Well, if you limit money's movement between effectively 3 institutions, in terms of, say, maybe 1,000 or a couple of thousand, you're crushing the velocity of money. And that's exactly what's happening here. Is there's nowhere for that money to go. There's no other options, there's no other choices, and it just gets stuck there. And that's by design of the program. So when in terms of the dollar, is why does this matter for the dollar? Because everyone thinks that the Fed's trying to weaken the dollar, which is the absolute opposite of what the Fed wants to do, because we are the global reserve currency. And if you are the global reserve currency, you want to maintain your status as the reserve. And so how do you do that? Well, would you devalue it so no one wants to transact in it? Or would you increase the value on it to incentivize people to transact in it? Well, that's exactly what the Fed wants to do, is make sure the dollar stays strong and perhaps even increases in value. And how do you do that if you cannot destroy money and you cannot print money because you don't have the tools or the abilities to do that? All right, well, think of it this way. If I could trap a bunch of money into the commercial banking system where it can't leave, well, then it doesn't move around as much. If it doesn't move around as much, you don't get any inflationary effects from it. And therefore, the dollars that are outside the commercial banking system moving around have more value, because again, these other ones are just stuck there. Think of like they're in a prison. You know, people in prison, they're still citizens, they're still people, they just can't go out of the prison. Well, that's what these dollars do. They're there, we can see them, we can count them, they just can't go out and do other things. And that increases the value of the dollar outside the system. And that's what the Fed's trying to do. Because when you ultimately think about what is the objective of all these things the Fed is trying to accomplish, is to try to get the global economy working again. And when you're the global reserve currency, and you're in the United States, what is the objective of the monetary system? Is to export dollars. I need to export dollars as much as possible. I need to export that inflation, put dollars out into the global economy. So how do I do that? Well, if I weaken the currency, and let's just pretend for some reason the Fed could print money and they devalued the dollar, as a US citizen in the United States, am I incentivized to take my weaker dollar and go and say buy a foreign produced, car? No. In fact, I'm highly incentivized to purchase a domestic produced car, which also would spur an increase in domestic production because of the weaker dollar. But to get Steve to go out and buy that foreign car that he's, perhaps always wanted, how would I do that? Well, we raise the value of the dollar or try to strengthen it relative to other currencies, and we lower interest rates down. And now all of a sudden, what do I see as a consumer? I can go borrow money, which creates money. I can export those to that foreign country, and that car that I want is going to be at a much better price because of a stronger dollar. And that's what gets the global economy going again. All the Fed is doing is trying to fill in the gap of where the economy went wrong due to the pandemic, and they do it with quantitative easing.
So, Steve, there has to be a ceiling to what the value of the dollar can be. Can it not? Because if it gets too high, then that's going to de-incentivize other economies and foreigners from using it, right?
Well, no. The issue you have is the strength of the dollar would have nothing to do with that. It's more of an issue of all the dollar denominated debt. So as a global reserve currency, people want to use the dollar. I mean, in a lot of sense, they have to use a dollar to conduct global trade. Now, if the dollar gets too high, what it's suggesting is there's actual shortage of dollars. And that's where you start to see financial crises start to happen, because people that have dollar denominated loans, which there are lots of them outside of the United States, well, they need to get dollars to pay those loans. Well, if the cost of dollars goes up, and you're an exporter to the United States, well, what does the value of your exports have to do? They have to go down, because maybe you need to export more oil or more cars or more whatever it is you're doing, widgets, because you need to get more dollars to pay on your debt. And that's why you see when the dollar goes up, you see other prices of things go down. It doesn't mean there's a limit to how high it can go up. Now, obviously, we wouldn't want it to go to 200 or 300, because that would tell you there's a massive dollar shortage, which is going to lead to a massive amount of global defaults. But what happens is the Fed tends to overshoot its targets, because there's a lag in monetary policy. And so that is something that we can't quantify. Is it a 6-month lag, 9-month, 12-month? We can guesstimate it, but we don't know any more than the Fed does. And so what happens is Sometimes they overshoot. In that case, the dollar will then go up, which is what I expect to happen. And all that does is tell us there just isn't enough dollars in the system. And that's where you start getting, a financial crisis to kick in.
So Steve, obviously we've seen over the last 2 years, massive, monetary growth, base money growth, inflation growth. We saw the PPI come out at 9.6% today. There's a bunch of arguments that are going to be, I can hear them already launched against you, that QE is inflationary. We've seen the monetary base grow like never before. So how are we actually getting the inflation here and the growth in the money supply if the dollars aren't being printed by the Fed?
Yeah, let's address the money supply, because again, that is probably the one that most people are confused by. Is when we go, because people look at the chart and they'll go back to the pandemic and say, look, the money supply went straight up, so it had to be money printing. And again, I challenge people to really question their conclusions and they should just ask themselves, where did the money come from? And that seems to be a question a lot of people don't ask. It's kind of back with the QE thing. No one bothered to ask what a bank reserve is. If they did, they could have gone back as I did and figured out that, hey, it's tied to customer deposits. It's not money printing. Mm-hmm. So what happened during the pandemic is we borrowed money from foreign sources. So outside of the US money supply, outside of the M2, brought it into the country and gave it to people who deposited in the commercial banking system, and it gets counted into the money supply. It wasn't printed, it was borrowed. And that's kind of what, Tom, I think makes it interesting when we talk about the potential dollar shortage that's going on, that we see as the dollar kind of ticks a little higher in strength. Is my bet is we see damage. Unlike the great financial crisis, which started here in the United States, I think we see the damage outside of the country because we pulled all of these dollars out, from foreign sources into the country. And then you look at the supply chain issue. So when people see ships off the shore of the Port of Los Angeles or Port of Long Beach, they're seeing goods and services. I'm not seeing that. I see things coming in that are going to get dollars. Because when those ships dock and they get unloaded, they get paid, and those dollars get exported back to those foreign countries. And boy, they really need them. And we see already seen in China, we've been seeing, defaults on some of their dollar denominated debts in the real estate sector. And, that is just telling us that there's a dollar shortage over there. And now, as far as the monetary base, that is quantitative easing. So, the Fed can create base money. They can create all the base money they want. And when we look at the increase in the monetary base, it is due to quantitative easing. The increase in the money supply had to do with borrowing money from foreign sources, and then the suppression of the front end of the yield curve, where there's really no option for savers. They didn't want to go out and buy a 30-year treasury, bond, because it was their savings, and there was just no other alternative. And so you see that build up in the money supply. You also saw it because a lot of not commercial banks, but you saw a lot of corporations borrowing money from commercial banks because they didn't trust the system to work this time. So they borrowed they pulled what are called their credit revolvers or their credit lines, and they took that money and they deposited in their account because they didn't know, if the government was, all their plans were going to work or not, because they trusted them during the great financial crisis. Didn't work out well. And this time they said, hey, maybe it works, maybe it doesn't, but we'll make sure we've got cash. So cash just kept getting piled and piled up into the banking system. And that caused the money supply to rise. And then the more money that gets piled up in the banking system, the lower rates go. So you have two things feeding on each other, causing a feedback loop going in the direction, of course, the Fed, in a sense that they didn't want, but they did want, because if rates go down, people borrow money, and that's what creates new money. But there wasn't enough money creation going on because the government was giving everyone money. They didn't need to go borrow because it's like, oh, hey, I've got these extra stimulus checks, and now I can, save it or pay these bills or save it for future bills. So they didn't have that pressure. Now we're seeing an increase in borrowing now, particularly with credit cards, as all that stimulus fades away and consumers are returning back to their normal demand for needing money. But I think, one of the things I want to challenge your listeners to do is, rather than jump to the first conclusion, which is it has to be money printing or something like that, try to chase this thing down to the end and really think about, where does money come from? How does it get to the places it gets to?
And again, I think a really important point to remember there is that as a reserve currency of the world, as there's demand from other countries for dollars, that really changes the dynamic. And like you say, to really think about, the downstream or upstream effects of where the money is coming into the system and how it's coming into the system, right?
Right. And the challenge right now is the United States is not exporting enough of those dollars back. And in a sense that you look at a perfect storm of what went wrong in terms of we see a lot of supply chain inflation, but we see a lot of what I'm going to coin the term fiscal inflation, is because, again, dollars are created inside the commercial banking system. Now, there are foreign banks that can create dollar denominated loans too. So that's the euro dollar system that we were not, but we're not referring to that at the moment. But all these dollars get created inside the US. Well, instead of creating them through the banking system, we borrowed them, brought them into the country, and closed the borders down. Those dollars couldn't leave. They couldn't get out. And so when you cram dollars into a financial system, it creates inflation in itself. Now, that had nothing to do with quantitative easing. It had to do with fiscal stimulus and the pandemic. Now the borders are open. We just can't get goods and services moved anywhere at any speed. And so these dollars are still trapped here trying to get out. And again, if all those ships that are sitting there waiting, at least out of California and other parts of the country, could just all start unloading, dollars would start escaping and moving back overseas. And you would see that part of that inflationary pressure go down, not only from a supply chain effect, but from dollars leaving the financial system.
Interesting. So, one of the other things that struck me when I was trying to understand that video is if the value of the dollars that are not inside the commercial banking system, if the value of those dollars keeps going up, one would think that would make the prices of, let's say, homes, for example, homes go down, considering that the value of each dollar is going up.
Right. And so I do want to clarify, even though their dollars are trapped in the commercial banking system, their value is going up, but they can't leave. So, that's the challenge as well. They're in that prison. They just, they can only move around a small amount. Mm-hmm. And as you know, I've been on your show in the past and we've talked about my macro thesis. And one of the most unpopular comments I generally make is that I am bearish on precious metals. Mm-hmm. And all stems back to my understanding of how quantitative easing works, my understanding of how the commercial banking system works, because when you understand that the value of dollars, the probability is likely to rise, what are the effects you're should see in the economy? You should see stock prices go down, home prices go down, precious metal prices go down, commodity prices go down, dollar going up, and bond prices going up. And when you get that, you go like, oh, okay, I see where he's coming from. It isn't because I have a dislike for homes or gold or anything else like that. It's just like, hey, I think this thing plays out in a similar fashion to the great financial crisis. I think the Fed overdoes it. And I think that causes the dollar to scream higher, and that causes a massive unraveling because everything else has to take the pressure off. And you start to think about it, a rising dollar just tells you the financial conditions are tightening. Same with a rising treasury bond. You see them going up. So, if those are telling you things are tightening and going up in value, what has to happen on the opposite effect? You have to have lower stock prices, lower real estate values, lower metals prices, lower commodity prices, lower, everything else has to come down to try to offset it. And that's the thing that people are missing because they're so fixated, as we talked about in the beginning, is what is the psychology here? All right, well, the Fed's printing money. Okay, well, they're not printing money. And even worse, if they were printing money, tomorrow they're going to announce how their money printing program, which is going to end in a few months. And now you have all these people overweight these asset classes and they haven't hedged.
Mm-hmm. So why don't we move on to the listener questions here? We've got quite a few of them. We'll start with kind of the ones geared around QE. So there's one here. If QE increases the strength of the dollar, wouldn't this work against the mandate for higher employment? Higher dollar equals higher costs for businesses equals higher unemployment.
Yeah, so that is a problem with our financial system, our monetary system in general. So just so we understand, I'm not a proponent of it. I'm just trying to explain to you how the system works because I hear all the time we should bring manufacturing back to the United States. Former President Trump, that was one of the things that he was really big about is we need to move that manufacturing back. And I kept saying it's not how the system works. We can't do that. We have to export dollars. And to export dollars, we have to export jobs. It's just the way the game works. And in exchange of exporting these jobs in dollars, well, what do? Those dollars come back in terms of buying our debt and buying other assets. So yeah, it's in a sense that a stronger dollar is not going to be good for the job market at all. I would totally agree with that.
Mm-hmm. He claims that QE takes money out of the system. So then why do markets not want QE tightening? Wouldn't this be good for the stock market?
Yeah. So people think, and this is, again, it comes back to the psychology of, what's going on, is people believe that it's money printing. And even if you can get past that hurdle and believe it's not money printing, because it's not, then what is the next thing you believe? That the Fed wants to create inflation. It wants to hit its 2% target. Now, I know, it's over that now, but, looking backwards at, QE 1, 2, 3, and where we started the latest iteration of QE, it was to get to this inflation target. So what happens is people buy into that narrative, even though we have absolutely no history to prove that QE leads to inflation. But what you see is investor positioning go like, oh, they're going to do 120 billion a month. Well, that has to lead to inflation. That number is so big, I can't even, make sense of it. Well, it didn't work at 60 billion in the past, but gosh, boy, 120, that'll do it. So by all means, I'm going to start repositioning my portfolio. I'm going to sell my bonds, get dumped dollars, and I'm going to buy all these inflation sensitive assets. And then you see the secondary effect of lower interest rates, and you look at margin debt, and you see all these people borrowing on margin, because what are they doing? They're chasing the inflation bogey that they think is coming, because bigger must be better, even though actually bigger is never better. I mean, Japan has proved that a long time ago. And so far, this one really hasn't. I mean, I know we're seeing supply chain inflation, but that will all normalize when this all works out. So what is the problem with investors right now is, if front end of the curve, so the short-term yields start to go up, well, all of a sudden that puts pressure on margin rates, and that's going to drive margin rates higher. If you don't get rising equity prices, all of a sudden you start getting potential, risk of margin calls, where investors either have to put more money in or start to liquidate. And when you have all this rampant speculation and you start getting people that have to start selling, well, selling begets more selling, and that's what starts to happen in the market. So in a sense that you look at the equity market, and tapering makes them nervous because of all the margin debt in the system. From the bond market perspective, you get a completely different look. Everyone thinks, oh, well, if the Fed's going to, there's going to be an increase in supply in bonds. Well, if there's an increase in supply and something nobody wants, then the price must go down, right? I mean, it's very simple. But what happens is the bond market doesn't care about that. What the bond market's looking forward and saying is, what are the growth and inflation expectations here? And they're lower. When you take that support from the Fed out from under the economy, both of those go down, and interest rates fall as suit. The other issue we have here is with the money supply. Because of the Fed's ongoing process of 120 billion a month, that means there has to be 120 billion a month of deposits showing up into the commercial banking system for the Fed to swap with. So that deposits have to come in, they have to be converted to bank reserves, and then eventually swap. So if the Fed is now going to zero, that's at least 120 billion a month in money supply growth that we can't count on anymore. And so what we've learned from the great Dr. Lacey Hunt is, you tend to get a deceleration of the money supply, and then that all of a sudden leaves less money to support asset prices, and then you tend to see a mean reversion.
Excellent. So why do banks have to participate in QE programs? Someone could argue that it is better to sit on treasuries.
Yeah, they choose to, because they have nothing better to do. So, I mean, yeah, if the Fed wants them, and again, the Fed offers it. I mean, it is an auction. So, it's not like the Fed is coming over and, it's not like your kid's doing something wrong and the parent walks up and grabs them by the arm and says, no, you're coming with me. This is the Fed shows up at their daily auction, says, hey, this is what we'd like to buy today. The banks could all step back and say, nah, we're not interested. We're not interested at all. They could do that. Now, why do they do that? Why do the banks actually participate? Because they get additional reserves from it. So, when that customer deposit comes in and they buy that treasury security, again, what is the purpose of QE? It's to suppress and lower interest rates. Now, I know some people say it doesn't always do that. Look, I understand it doesn't always do that. What I'm telling you is what it was supposed to do. And one of the ways it does that is if the bank buys a treasury security or creates a bank reserve by buying a treasury security, and they flip it to the Fed at a higher price. Now the banks don't profit on the gain; they just get more reserves. But if they sell it to the Fed at a higher price, what does that do to interest rates? Cause them to go down. Mm-hmm. So what is in for the banks? They get extra reserves, and that means they get a little more interest, because of their reserves.
Mm-hmm. Steve, as we're talking about this in your last answer, the end of QE, this was making me think about a podcast I was listening to the other day from Quoth the Raven. Chris Irons was talking to one of his guests and saying that when the end of QE comes in, then the bond vigilantes can come back in. So what effect could that have to you? Do you think that could have an appreciable effect on interest rates?
No. In fact, history suggests otherwise. And again, we come back to the bond market doesn't work the way most people think. Mm-hmm. And it's a shame that we have this incentive to learn about stocks and trade stocks, but the bond market, every investor owes it themselves to try to understand what it is, because it tells you a lot of things. And so why do we see when the Fed tapers or quits doing QE altogether, or why do we see interest rates fall? And again, it comes back to, what is the bond market telling you? It's talking about future growth and inflation expectations. So that show you were referring to, if interest rates were to go up, then that would tell you that by tapering the balance sheet, growth and inflation expectations were rising. The bond market is telling you the exact opposite happens. It's telling you without the Fed support of the economy, that it stands no chance. And that's really the key thing to understand is the bond market since March, we saw 30-year treasury yields peak in March, is already telling us, even when the Fed was still doing 120 billion a month, and right now they're scaling back and everyone's kind of acting as if, the end is here. They're still easing. They're just not easing as much. And what have we seen? Financial conditions tighten, interest rates are falling. So when the Fed pulls that final support, that's why we're going to see interest rates go down, not go up, because it's telling us the economy is going to reverse direction, or at least the probabilities that it's going to reverse direction and go down are very high.
So how does QE add liquidity when they are really removing it, assuming this is a misconception?
Yeah, that's a very big misconception. And I always like to say quantitative easing tightens until it eases. And so what do I mean by that? Until you get rates down low enough where people come in and borrow money from the commercial banking system and that creates new money, it tightens, because lower interest rates tell us financial conditions are tightening. They tell us future growth and inflation expectations are declining. And so the Fed just doesn't, since they can't create money, they only have one thing they can do is lower interest rates. And that's what's weird about it, is they tighten financial conditions, hope things don't break when they do it, and that they get it low enough at the just right level. People come in and borrow money, and that new money enters the economy, starts moving around, and starts creating the inflation and growth that the Fed needs. And then, of course, they could then at some point scale back because they don't need rates to stay that low, and the whole thing should keep going. That's the bet right now. Is fact the big mistake the Fed is making, and I think they're under a huge amount of political pressure. Is that they're chasing supply chain inflation, and monetary policy does not make ships unload faster at all. Now, can they chase money printing inflation? Sure. But then again, we come back to the original conversation of, well, they didn't print any money.
They borrowed it.
Well, no, the Fed didn't. Well, the government borrowed, but the Fed didn't print any money. No money was printed. So now all of a sudden we're going to start to decelerate or we're decelerating the balance sheet purchases. We're going to end the taper, and all of a sudden the whole thing is going to fall apart, because what we need to support these higher asset prices is we need money to come into the system to support it. And so right now the Fed is marginally keeping up with it, unknowingly pull that out of the system, and the economy stands no chance. But again, this isn't anything new, because we can go back in history and you can see every time the CPI goes up, it comes crashing back down along with the economy, because there's never enough money created to support these higher asset prices. And again, if QE was money printing, well, it would work, but it's not, and that's why it doesn't. So yeah, what the Fed's about to do is it's going to be disastrous.
So we might have already kind of addressed this one. Ask what are the options the bank has with the bank reserves they get from the Fed QE. If they can buy issued treasuries with it, can they create a QE buy loop allowing infinite government financing?
No, the banks cannot use reserve assets to purchase more treasury securities. Again, you have to understand where these come. They come back from a customer deposit. So can that customer deposit be used twice to buy something? No, it can't. It can only be used once. So no, there's no infinite loop here. That does not work. So what do these reserve assets do? Well, they don't do much, but they do a few things. One, they can be used to settle overnight intrabank transfers. So let's go back to those three banks, B of A, JP Morgan Chase, and Wells Fargo. At the end of the night, when money's moving between all the banks, rather than transact it between them during the day, at the end of the day, it all gets netted out and says, okay, B of A, you owe, JP Morgan, but Wells Fargo owes you. And here's all the amounts that everybody owes each other. Mm-hmm. And they can just simply move those reserve assets between them. In fact, the Fed does that for them, through their system. It says, here you go, everybody gets netted out. So they're used to settle intrabank transfers is one thing they do. Number two is they can be used at a treasury auction as a deposit. So, when you go to an auction, typically depending on the size of the auction, you have to put some money, down to show you're a legitimate, bidder. In this case, the commercial banks, or actually the primary, let me say not the commercial banks, the primary dealer banks can post these reserve assets as collateral at the auction. And they're not using to pay for them. They're just saying, hey, yeah, we are a legitimate buyer. And then they get the treasury securities. And as those treasury securities are sold from the auction by the primary dealer and they get cash, that cash is given to the treasury, and the treasury then releases back those reserve assets. So again, no money printing, no infinite loops there either. And the last one is they can use those reserve assets as collateral for creating a new loan. Of course, the risk to the bank is if that loan goes bad, well, they're on the hook to take the loss. So that's why we don't see, we're seeing an increase in lending, but we're not seeing, the banks going crazy with it because, they're on the hook for that liability. And with rates so low right now, there's not a lot of margin for error in the lending space. So there's not a huge incentive to lend out at these low rates. So just to clarify the question, there's no infinite loop going on, and the reserve assets are largely useless, but they do have a few functions inside the commercial banking system. But keep in mind, they are held at Federal Reserve member banks. They're a property of the Fed. So there's no infinite loop. They can't move around much. They're stuck there.
Perfect. So there was a really interesting point raised in a video that somebody posted. They wanted you to comment on it, and I'll just give you the gist of it. So there was a video about a debt Q&A about when the central bank or the Fed, I'm assuming, buys the bonds from a non-bank financial institution. These institutions can then go out directly and buy shares or housing. So in this case, would QE result in shares and home prices to go up?
Yeah, so the Fed isn't buying from the public. The Fed is not buying from the primary dealer banks. They're only swapping with the commercial banks. Now, where are the commercial banks going to get the bonds that they need? Though they're going to go to the primary dealer banks, mainly because that's what they are. I mean, it's like, saying I need to go get some groceries. Well, I'm going to go to a grocery store. That's, the primary dealer banks are the grocery store of treasury securities. They go to auctions, they buy them, and they resell them. That's what they do. So the commercial banks, who happen to conveniently own most of the primary dealer banks, are going to go there. Now, where the primary dealer banks source their supply, if let's say they're short and there's a demand for a whole bunch of 2-year notes and the dealers don't have enough, well, they have to go out on the market. But are they calling up people and say, hey, I need you to sell? No, they're not at all. The market is allows people to sell, prices moving higher or lower. So let's say you hear the common argument, well, a hedge fund is going to sell. Well, the hedge fund is going to sell based on whatever they want to sell or not. Whether the primary dealer bank's on the other end of the transaction or someone else, we don't know. But if the hedge fund sells a bond because they believe the QE is going to lead to inflation, and it just so happens that a primary dealer bank buys it because they need to sell it to the commercial bank who's going to flip it to Fed, then of course, what can that hedge fund do? Can they turn around and buy equities with it? They sure can. But the notion that the Fed was directly influencing that hedge fund to sell is ridiculous. The Fed does not call up some hedge fund and say, hey, we're going to need some bonds and we see you got a lot of them. Can you sell some? No, the hedge fund and all these other investors are looking at the market and making independent decisions of this. And there's two ways you can get people to sell things. You can cause prices to go higher or lower. Now, it's odd enough that if you want people to sell their bonds, you drive rates up. And the lower they go, people get panicked and they sell. When interest rates go down, people tend to hold on to them. So what happens is all these people, again, bought into the notion that the Fed is printing money or going to actually maybe create inflation this time. And they all just became sellers and they overwhelmed the demand that the Fed had. And that drove interest rates down, drove more people to sell, and it worked. But is the Fed causing home prices to rise specifically or stock prices to rise in these transactions? No, these are just what people are choosing to do when they sell, or what they're choosing to borrow money at these low rates and do with their money.
Excellent. So in a risk off or deflationary period, can the US dollar, bonds, and gold all rally together?
Yes. However, I will stick with the fact that gold goes down first before it goes up. I strongly suggest, and again, you and I, we've talked about this on shows in the past when you've had me on. As I keep saying, I'm bearish on gold in short term, bullish on gold in long term, because and again, I've stated clearly before, can I be wrong? Yes. However, I think the probabilities of me being wrong are rather low. Is in a risk off event, what you see is people sell things they have to get what they need. And what do they need? They need dollars. And what is great about things like gold, silver, and crypto? They're all after-tax investments, right? You got to think about what the average person is doing is, say, hey, so let's say I lose my job and maybe my wife's hours get, her job, she gets cut in half and we got 3 kids at home and they're all hungry and we have no money. We sit down at the table like, look, how are we going to feed the kids? Well, hey, Steve, you've got $500,000 in your 401k. Why don't you cash it out, pay the taxes and the 10% penalty? No, that's not going to happen. That's your last thing you're going to do. So what are the first things you're going to do? Well, you're going to open your safe and maybe sell some of your physical metal. You're going to maybe go onto your crypto exchange and sell that. You're going to sell all your after-tax stuff. Maybe sell that extra car you have. Sell that, baseball card collection. You're going to sell the things you can sell now that don't create more problems later. Now, when you go through all those things, now you run into the stuff that, okay, well, if I sell, my IRA or my 401k, now I got taxes and penalties. So the reason you see things like gold and silver and potentially crypto go down in these events is because people sell what they have to get what they need. And what they need is to make sure that mortgage payment is paid to keep the roof on their house, because you don't want, if you really want to upset your wife, have 3 hungry kids and no roof over that. I guarantee you your day will probably not look good, and you will do and make those decisions to feed those kids, put the roof over the head, and keep things going as long as you can. And that's what happens here. Now, the end result of this, and why I am bullish on gold and metals in the long term, is as this event unwinds, what you see happening is you see the Federal Reserve will come back in at a bigger and bigger number. And what is the psychology? And again, the psychology here is about half of this whole argument. Is what will be the psychology, Tom, if I said, hey, instead of doing 120 billion a month, which we've done before, what if the Fed goes to 500 billion? Maybe they go to a cool $1 trillion a month. Do you think that will create inflation? And you might go, man, if that doesn't create inflation, I don't know what will. Bingo. And it's that expectation that will drive precious metals and other assets straight up. But the key is, in the meantime, you have to think about people selling what they have to get what they need. And in a dollar-based system, all knees eventually bow to the dollar when you've got dollar-denominated debt.
Yeah, it's really interesting to look at it from that perspective of, in the short term, gold from that perspective, like you said, is very likely to go down. I would push back on something you said at the beginning that most people are overweight precious metals. If we look at historically how much metal has been held by the market in general, we're way below the historical average. But considering the explanation that you just gave us, there is an absolute, short-term bearish case as everybody sells what is liquid and what keeps, the roof over the head.
Yeah. And I'll agree with that. And I think we could both maybe agree that the advent of crypto has caused some people who would hold gold normally to switch over to that asset. But you also understand what I mean by overweight. You could also mean by you just don't own enough other stuff. You know, I can be overweight stocks by not owning any bonds and having any protection. You know, if I have my house and I don't have any insurance, fire insurance, and it burns down, well, clearly I was overweight house and underweight insurance. You know, so we have to look at it from a perspective. It doesn't mean I own too much of it. It just maybe means I don't have it properly insured. And that's always something that, you know, and we've talked about and previously is, look, what if I'm right? Do you have the insurance? Or are you driving around town with no car insurance thinking, Steve, I've never been in an accident in 30 years. It's not going to happen. Well, every time you get in the car, the probabilities start to reset, you know, and you could have that accident and you're going to want to have that insurance. And that's what we're talking about here is if the dollar goes higher, if the system works the way I'm sharing with your audience that it does, the dollar goes higher, bond prices go higher, interest rates go down, and there's a wreckage across all these other asset classes. Now, if I have a lot of gold or other things and I'm bullish on it and I'm bullish on it within my time horizon, which is cool. Maybe, you know, maybe you've been buying it because you've got, you know, a 5, 10, 20-year time horizon. Awesome. I respect that immensely. Do you hedge it? That's all we're talking about is, hey, what if gold does drop to say 1,300 an ounce? And you go like, man, I'd be a buyer, but what if you don't have any money? That's the beauty of what a hedge is. You sell your hedge, free up some cash, and you buy again. That's the beauty of it. But that's the problem with the system is because there's all this dollar denominated debt, when things go wrong because the Fed can't fix the problem by printing money, it breaks apart. Everybody's forced to sell things to get the dollars they need. And then when things crash, guess what they don't have, Tom? They don't have the dollars to go buy things when they're low. And again, by the time they get dollars, they're paying high prices again.
So right in exactly what you were saying, there's a perfect question here. Would love to hear Steve's opinion on what tools the Fed will try to use on a large drawdown in the equity market and if they will be successful again.
Wow, that is a great question because I've been thinking about this over the last few days. In fact, I've kind of been tweeting about it to get people's feedback on it. And in the past, and I need to go back and look at the dates. I haven't had a chance to do that. In the past, when the market went down, it gave the Fed free rein to do more QE. Now, we know they can't take the federal funds rate below zero, so that's out the picture. So they're going to do more QE. But in the past, it always came with the notion that we're under the Fed's target, so they could get away with it. But now, with the CBI running around 6%, how can the Fed possibly justify more QE when you go and look at major newspapers like Wall Street Journal, you look at Bloomberg, you listen to the nightly news, and what is everybody blaming the Fed for? They're blaming for the inflation. So the Fed, even though like you can dig through all this and say, they're really not responsible for supply chain problems. They're not responsible for this, but everyone's pointing the finger and say, hey, Fed, you caused this inflation. So if the market starts dumping, how can the Fed justifiably come back in? And the answer is they can't. And that's what I think is right now, one of the big issues is investors have been solely focused on two things, the Fed put and corporate share buybacks. The economy slows, the buybacks are going to go down, and the Fed put, I don't think the Fed can come back in because, again, this becomes very political. And we don't know what the conversation was when Fed Chair Powell went to see President Biden to interview to get his job back. And I have a hunch that it was focused on, oh, by the way, we need to keep these inflation numbers under control because when inflation goes up, well, there tend to be one problem for politicians is they get voted out of office. There's this thing called the midterm elections coming up in next November. And I guarantee you, and we know historically that whoever is the majority power going to the midterms tends to lose it anyways. Now the only question is, okay, if history plays out and the Democrats lose the majority due to inflation, do they lose it by a mile or they lose it by a little bit? And they need to get inflation under control. I think the Fed put completely out. I don't know when they come back, but I don't think they come rushing back at all.
Yeah, it's going to be interesting to see what their reaction is. So, Steve, why does the S&P track the Fed balance sheet?
Because you can make charts track whatever you want if you line them up really well. I think the really chart that matters is margin debt. Track the S&P against margin debt and stop tracking against the monetary base. Because as we pointed out, there's no process in this transaction, the Fed swapping, that involves the purchase of any equity. None, zero, zilch. So the fact that it's there is, it's just because there's a correlation doesn't mean there's causation. The real reason the S&P is rising is due to the massive expansion of margin debt.
So there was a couple of questions about the fractional reserve banking system and how that can create dollars. So how does the commercial banks being fractionally reserved affect this, and the fact that they no longer have even a minimum balance for that fractional reserve? So kind of walk us through how that fractional reserve system works and how that is creating dollars, or if it in fact is.
Yeah, so a commercial bank can lend, I believe the number is 9 times against a deposit, but we're lending less than 1. So there just isn't enough. There's way too much on deposit and not enough demand for lending. So, I mean, is it a fractional reserve system? Yes. Is it fractionally reserving right now? Not so much.
Interesting. So how is the infrastructure bill not effectively money printing?
Yeah, because we're borrowing money. Just the same way all infrastructure bills are, all government spending is borrowed money. It's 0.0% of it is printing money. The federal government does not have the ability to print money. The Treasury doesn't have to print money. They're borrowed from the existing supply of dollars. So, not money printed at all.
So there was one comment, Steve, that said the whole video seems back to front. Surely the Fed is aware of how they affect the market, aren't they? Aren't they trying to get inflation to reduce the debt burden? I guess no, because it isn't a part of their policy.
Right. Yeah. So does the Fed understand how the system works? This is where you can look to a lot of research from my friend Jeff Snyder, where you can make a lot of good arguments if they don't know how the system worked at all. And no, the Fed's focus is not what the government pays in interest at all. That's not their focus at all. Their focus is the dollar. I mean, what is their child? I mean, you think about what is the child of the Fed? It's the commercial banking system. It's the dollar. That's what they care about. You look at why does the Fed buy the commercial banking system? Because they're the banking system regulator. I mean, if the commercial banking system fell, that would really look pretty bad for the person regulating them. But yeah, the Fed cares about the dollar. They cares about it more than anything. They want to make sure the dollar stays a reserve currency. It's not their business what interest rate the federal government pays. And you'll hear Powell say, look, this is up to Congress. And he said in the past, before the pandemic, people forgot that he was telling the government, telling Congress, you need to cut your spending down. You're part of the problem. Well, oddly enough, the more government debt we issue, the lower rates go. So in a sense, if you want to create inflation and you want higher interest rates, it'd be wise if Congress ran a surplus and paid down the debt of all things.
Mm-hmm. So is QE market inflation not inflation since it's based on debt? What, if any, are the actual effects of QE or taper, and why? And after debt is reduced, higher interest rates should equal inflation since more dollars are created, at least until it's so high that it stifles growth.
Yeah, I'm kind of struggling to piece together the whole question.
Yeah, I'll repeat the first part again.
Yeah.
Is QE market inflation not inflation since it's based on debt?
Well, it's only inflation if people are borrowing money to buy assets with it. So, if interest rates go down and everyone buys homes with them, like we saw going into the great financial crisis, this is going to create home price inflation. If people are borrowing money on margin to buy stocks, it's going to create stock inflation. So what we don't know is what people are going to do when rates go down. Now, in this case, rates went down and stayed down to the point where people were, when you think about when you borrow money, what you're trying to do is, can I take this money I'm borrowing and make a higher return somewhere else? And the answer started being is, yeah. And on what? You can buy baseball cards and probably make more money. So what did people do? They bought money, or they borrowed money, and they bought everything. And so what appears to be that the Fed has some magic wand that caused asset prices to go up. And if that, again, Tom, if this was true, then what should everybody be doing right now that on the eve of the Fed saying, look, and by the end of March or thereabouts, we're going to cut all of our purchases. And then we're probably going to, I'm going to bet they're going to announce some sort of, hey, by mid 2022, we're going to either be raising the funds rate or doing quantitative tightening or some combination thereof. Then if you believe in all that, what should you be doing right now? Selling everything. Mm-hmm. And what are people doing? Look at retail flows into equities, record all-time highs, at least I saw last week or so. So no, people are, they're saying one thing and they're doing the complete opposite. It makes no sense.
Mm-hmm. I think we've pretty much touched on the rest of that. There's another two questions here that I'd like to address here before we wrap up, Steve, if you wouldn't mind.
Sure.
So one is the crux centers on whether the Fed is monetizing the debt. I believe Lynn Alden thinks QE reserves can be used to buy treasuries. So besides the quote unquote law, how do we know if this is or isn't happening?
Yeah, I have a great deal of respect for Lynn and her research, and reserve assets cannot be used to buy treasury securities because, again, as we already explained, and we answered this question earlier, it comes back to, and people don't want to ask a question because, again, they want to have these conclusions because it fits their narrative of investing. And that's just the wrong way to look at it. If a reserve asset is tied to a customer deposit already, how does that customer deposit get to buy a second thing of anything? It doesn't make any sense. But people want it to be this way because of whatever their narrative they're pushing or selling. And I'm not saying this about Lynn Alden. I'm just saying this again about investors broadly. They need so desperately to buy into this because look at their positioning. Margin debt's off the charts. Positioning is, massively in risk assets. You've got to believe it because if you find out that the truth is something different, then guess what? When this thing unwinds, you can't get out. Mm-hmm. So no, reserve assets cannot be used to purchase treasury securities that are tied to your deposit at your commercial bank. So there's no way that money can be split twice into two things. If it could, then we would see the why are interest rates going down? If we were doing all this money printing, it doesn't make any sense. And again, people are so focused on their narrative, Tom, they can't actually. They just need to open the windows and look out in the world and be like, oh, it doesn't look like that at all.
Mm-hmm. So the next part of the question is something that I got to speak with Jeff Snyder about. So where is the M2 coming from, if not credit expansion or printing? Is it all euro dollars?
Well, it's from dollar. Yeah, I mean, if you're using the definition of euro dollars of dollars outside euro dollars are deposits and dollar deposits in the foreign banking system. So where is the growth in the M2 coming from? Is coming from the U.S. government borrowing money from foreign sources, those dollars coming into the United States and then being given to businesses and consumers who are depositing them in the commercial banking system. There's your money supply spike.
Perfect. So, and if it is euro dollars, even if the U.S. isn't monetizing its debt, if other countries are, does that somehow lead to more euro dollars? And where are the primary dealers getting all the funds to buy treasuries if all these dollars have been going to jail?
See, we're not monetizing debt. I mean, we've already proven that because we've already shown that if its customer deposits are being used to buy treasury securities, so there's no monetization going on. Now, where are the primary dealers getting money from? Well, to buy at the auctions. Well, that's simple. If I go to an auction, let's say I go to a car auction and I put down, a $2,000 deposit and I bid and win the car. Well, and then I turn around and they say, okay, Steve, you've got, 3 days or 5 or 10 days to make good on the 10,000, the balance of the payment of the car, the $10,000. Mm-hmm. What if I flip that car, Tom, before the money's due and I flip it for $12,000? Well, I can pay the auction house off, get my deposit back, and I'm good. Mm-hmm. The dealers are granted this special provision to be able to buy things at auction, and with the notion that they're going to sell them. I mean, they're not trying to make a marketism. They're literally just a dealer. You got to think of them like a Walmart or a Target or whatever your favorite store is. They're literally just a retailer of treasury securities. Now they've been given some special provisions to be able to get these without paying for them. But the notion is as they sell them, that cash goes back to the treasury. Mm-hmm. And that's what happens. Now, there's times when the treasury runs short on money, and sometimes you'll see interest rates go up, spike up. Now, why? And that it doesn't happen hardly often, but why is that? Because the treasury is effectively calling up the primary dealer bank and say, hey, we're out of money. And guess what? We need you to sell some of the treasury securities. And so they go out there and say, well, we'll dump them. And when they dump them on the market, what happens? The price goes down and all, but that's just the way it is. The dealers, they're not sitting on hundreds of billions of dollars in cash just to fund the government in and out. No, they're literally functioning as a dealer in perspective and floating until they sell the stuff.
And tied to that, please ask him about the end of LIBOR and what it will mean for the Eurodollar futures contracts and the Eurodollar system.
That would be a really great question for my buddy Jeff Snyder.
Okay, perfect. Well, Steve, that's all of the questions. We made it through pretty much everything there. I think that really puts a neat bow on everything in and around QE, how dollars are created or lent into the system, where they came from, and really ties up your thesis really well there. I really appreciate your time and your willingness to address all those questions. Is there anything else that you want to kind of go over before we wrap up here?
No, Tom, I had a really great time, and I want to thank all of everyone who submitted questions. Even if your question didn't get answered, I want to let you know that you have a voice, and all of us out here we're listening to you, and we want to create content and answer your questions and be your resource. So again, thank all of you for participating in the show, and Tom, thank you for having me on. And I'm just really excited about being able to share this knowledge with people, and hopefully expanding their understanding of the system and how things work, so they can be better investors and better stewards of their money.
I couldn't agree with you more, Steve. And I went through, and I probably addressed at least 80% of the questions that were submitted. So thanks to everyone for submitting those questions. And thanks to everyone for being civil for the most part about it. Of course, Steve, you're available on Twitter at MeterSteven. Is there anywhere else you'd like to point to?
Yeah, of course, on my YouTube channel as well. But I think there's a plan to post this on both of our channels. So if you're seeing it on my channel, well, then you need to check out Tom's channel, which is Palisades Gold. Is it Gold Radio? I'm sorry, I don't know if I got
Palisades Gold Radio.
Yeah, check it out. He does a lot of wonderful interviews. And if you're on Tom's channel, well, come look me up, because you'll see a different look and kind of a weekly show we do going through the major news topics and how the economic data ties back to all of that.
Absolutely. And Steve, I enjoy. I really try with the show to get all perspectives, right? I've interviewed Jeff Snyder. I've interviewed Lynn Alden several times. I appreciate having your time as well. And the more we can learn about the intricacies of the market and really, weave a tapestry of sorts of opinions and an understanding of how these markets work. I think that's valuable for everyone. Steve, thanks so much for your time today.
Tom, thank you very much. It's been my pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.